All right, everybody. Welcome back to Strongman Personal Finance. Today, we're going to talk about how to actually understand what you're reading when you're doing research on a mutual fund. Specifically, we're going to look over a Vanguard Target Retirement Mutual Fund. If you like my videos, you better start liking them because it helps promote my channel on YouTube. I know it's hard to hit the like button. And if you want to see more of these videos, then subscribe to my channel and hit the bell button for notification. Okay? I know you can do it. Anyway, like I said, if you have no idea what you're looking at when you're doing research on a mutual fund, which I've talked about in previous videos, it's where people pull their money together, give it to fund managers, and then those fund managers invest the money for them based on the mutual fund's, desired investment objective. If you have no idea what you're looking at, I'm going to show you exactly what to look for. So here I have the Vanguard Target Retirement 2060 Fund with the ticker symbol VTTSX. And this mutual fund is designed for it's a one-shop stop for somebody that wants to invest, doesn't know much about investing, just wants to put their money in one place and let a company take care of it for them. All right. So when you look at this mutual fund, you first want to look at the overview and you have the product summary. This basically explains what the mutual fund is, what it offers. Okay. This will give you kind of a snapshot of what it is. Now, it's not going to explain everything, and you need to do more research than just looking at what the fund offers. But it's a good place to start, okay? Now moving on to the fund facts. Asset class. This is a life cycle fund. Now, you have different types of mutual funds. You have mutual funds that invest completely in stocks. They could be large cap stocks, mid cap, small cap, value, growth. There's a ton of them out there. You have mutual funds that invest in bonds, inflation protected bonds, government bonds, corporate debt, yada, yada, yada. Basically, almost any asset class that you can think of, there's a mutual fund for it. Okay? In this specific example, this is a life cycle mutual fund. Now, what that means is, for a target retirement fund, you would pick a fund like this if you wanted to retire in 2060. If you want to retire in 2060, this is the fund you pick. Now, what it does is it changes your investment over time from more risk to less risk. So in this case, it's going to go from, you're going to see a lot of stocks in the beginning, and then as the fund gets closer to 2060, it's going to take on less and less risk to preserve your balance. So this fund will change your allocation for you. You don't have to go in there and buy and sell bonds and stocks or whatever. Everything is done for you. It is a life cycle fund. It changes over your life, all right? The category is target date 2051 and plus. Now, there's different categories for life cycle funds. This one just happens to fall in the category of 2051 plus. Acquired fund fees and expenses as of January 31st, 2020. Now, this expense right here is called the expense ratio. This is how much you're paying of the entire balance per year. So if you have $100,000, we'll do a quick example here. If you have $100,000 invested, you're going to pay $150 a year in management fees, which is pretty freaking cheap. Now, the average mutual fund, you're going to pay about 1%, which is pretty freaking high, and you don't want to be doing that. But at Vanguard, they offer extremely low fees. And for a mutual fund that buys and sells and modifies your asset allocation for you, it's a pretty good deal. That is a pretty good expense ratio, okay? And they even have a little thing here where it's 67% lower than the average expense ratio with similar holdings. So this is one of the reasons that I recommend Vanguard. All right. Minimum investment. You have to invest a minimum of $1,000 up front to invest in this mutual fund. Now, different companies will have different minimums, but in the case of Vanguard, sometimes they have $3,000, sometimes they have $1,000, sometimes they have $10,000. For this specific fund, you're going to have to put $1,000 down up front to even start investing in it. And then after that, you can do whatever you want to do every month. But they don't want just people investing with $1 or $2 right off the bat. You have to put some money down, okay? Then you have the fund number. These are just numbers that track the mutual fund, okay? Or basically, it's a way to find the mutual fund. All right, now let's move on to price and yield. Now, this is the price of a share, one share of the mutual fund. This is not the price of the entire mutual fund. If you want to buy one share of this target retirement mutual fund, you have to pay $39.24. Now, the way they calculate this price is by taking all the assets, all the bonds, all the stocks, whatever that's in this portfolio, and they divide it by the number of shares. And that tells you what the price is per share. So if you contributed $1,000 up front, you would have approximately, and yeah, you can have partial shares. You would have approximately 25 and a half shares of this mutual fund. And hopefully it would go up in value over time. And then that share price, you'd have the same amount of shares if you never invested again, but that share price would increase, okay? Now this change here, this is just the daily change from yesterday. Now, every day, the stock market opens at 9:30 Eastern and then closes at 4 p.m. And what the mutual fund people have to do is once the market closes, they have to calculate the total value of all the assets in the fund and then divide it by the number of shares outstanding. And once they do that, then they can figure out exactly what return they had for a day and what the actual price change of each share was. So yesterday, because the market's just closed, so there's no way this is going to be updated yet. Usually it updates around 6:30, 7, something like that, 7 p.m. So this is yesterday's one-day return, okay? You're going to see it going up and down, up and down, up and down. But over the long run, you're going to see it go up, okay? Moving on. We have a 30-day SEC yield, and you can click on that, and it kind of gives you an explanation. But basically, all this is an annualized representation of the distributions this fund is going to pay out to you annually. So if you have $100,000 invested, you're going to get approximately $2,040 in distributions, either in dividends or interest or both. That can either be paid out to you and you take it in your bank account, or you can reinvest it back into the mutual fund. In my personal opinion, you want to reinvest this back in the mutual fund because this is part of the total return. But when you see this 30-day SEC yield, it's not how much you're getting. You're not going to get 2% of your fund's value in distributions every day. This is annualized. This is 1 year. Okay? Then you have the risk potential for, the reason they have that is because since the target retirement is in 2060, it's going to have a ton of stocks in it. All right, but the biggest risk isn't investing in stocks. The biggest risk is you. If you get freaked out by stock returns and you sell at the, shortest sign of the market crashing, that's bad. You're the biggest risk. Over the long term, stocks generally go up pretty significantly. So don't be scared off if you see this number, this high number of risk, less risk to more risk. All that means is you might see rapid fluctuations in your portfolio, okay? Moving on. Performance, average annual returns. Now, it breaks it up and it compares this fund itself to an index, which is the benchmark. The benchmark is basically what this fund is comparing its performance to. Now, if you look at the 1 year performance, you see, let me see if I can zoom in a little bit. You can see the 1 year return is 2.95%, all right? For 1 year, whatever. 1 year returns don't really mean anything. But if you look 3 year, 5 year, and then since inception, you can see that the returns are pretty significant. Now, the rule of 72 says that you will double your money. You take 72 and you divide it by your annual return, and that tells you how long it takes to double your money. So if you invested in 2012 and you had an average annual return, this is per year on average, you would double your money roughly every 8 years. Every 8 years invested in this fund, as long as you don't do something stupid like selling it when the market crashes, you're going to double your money every 8 years, which is pretty freaking cool. The biggest point on this is that when you see these numbers up top, the 9.16, 6.76, that is an average annual return. So some years it might go up 23%, some years it might be down 10%, but on average, when you take all the years that this fund has been active, Since inception, this fund has returned 9.76 per year on average, okay? But you're not going to see 9.16 every year. Does that make sense? Good. Now moving on. Hypothetical growth of $10,000. So if you threw 10 grand in this fund, starting when the fund came into being, and then you go all the way to today, look at that. So it's been more than 8 years since the fund has been around. And look at that. You go from 10,000, boom, all the way to 23,000. Now, as you look on this, you're going to see ups and downs, up, down, up, down, up, down. Now, the mistake that people make is when they see their fund crashing, oh my God, I'm losing money. I got to sell. And that's the worst time to do it, because if you see, every time the fund crashes, in the next couple of months or years, it goes right back up. And over the long run, you go from 10,000 to 23,000. Now, keep in mind, this is a hypothetical growth of $10,000. So if you're somebody that's buying and selling and buying and selling and trying to time the market, Jesus, then you're not going to see this exact return. But if you bought and held at when the fund was created, this is the hypothetical return that you could see. So this kind of demonstrates why it's good to just buy and hold, okay? All right, just some random crap here, kind of explaining how it all works. Now we have the portfolio composition. This is where you really want to look to try to understand what the fund is doing. Now, for this is a target retirement fund, so it actually is a fund of funds. It invests in other Vanguard mutual funds at a certain percentage. Now, in this example, it invests in 4 mutual funds. You have the Vanguard Total Stock Market Index. 54% of this mutual fund, so 54% of your investment, is invested in the Vanguard Total Stock Market Index. That's the U.S. domestic stock market, okay? Next, we have the Total International Stock Market, 35%. That's all the stocks that are traded on international exchanges, okay? So you have exposure to U.S. markets, and you have huge exposure to international markets. It's got a little bit of bonds, and then a little bit of international bonds. So it's a extremely diverse portfolio. You're invested basically in the world through this fund. You're exposed to the entire fluctuations, returns of the entire world, okay? And then we have the fund net assets. This is how much money is actually in the fund. Now, one thing to keep in mind is this fund doesn't own the entire world. This fund only has $5.7 billion. But it invests in stocks that represent the overall returns of the world, and with a little bit of bonds, okay? Hopefully that makes sense. So if you own this entire mutual fund, you wouldn't control all the world's companies. It only has $5.7 billion in it, all right? Moving on. Let me zoom out just a tad. All right, now we're going to move on to get a little bit more detail about price and performance. All right, so once again, this is the price of one share of the mutual fund as of September 9th, yesterday. This will update around 6, 7, 8 p.m., something like that. And we talked about most of this, the SEC yield. This shows the 52-week high. This was the highest value that the fund share was at for the last 52 weeks. And this was the low. So it kind of gives you an indicator of the volatility of this fund, okay? You have a couple historical prices. I mean, if you're a long-term investor, this is really meaningless. But, if you want to see what the price was yesterday or 2 days ago and then last week, here's where you look at the price of one share of the mutual fund, all right? And you can actually search for different price information, but it's really not a big deal, okay? Now, going down here, this is showing, again, the hypothetical growth of $10,000 if you invested it. You can do it over 1 year, 3 years, 5 years, 10 years, okay? You can also add other funds. So if I wanted to add let's do Vanguard. Let's compare it to the S&P 500, even though it's not a good comparison because it's not the S&P 500. Now, this is the S&P 500's performance over the last 10 years. You can compare it and see how your returns would have been different had you invested that money in the S&P 500. Now, one thing to keep in mind is that the Vanguard target retirement funds have domestic stock, international stock, and domestic and international bonds. The S&P 500, this yellow line, is just 500 of the biggest companies in the United States. And you may think that these returns are insanely different. That's because domestic stock has performed well. It's performed better than international stock over the last decade. However, that may not always be the case. So you don't want to look here and compare apples to oranges because you're not comparing the same thing. This target retirement date fund is completely different than the S&P 500, okay? But you can select other benchmarks to kind of compare the performance, but you need to be careful what you're comparing your fund against. You want to compare this fund to other target retirement 2060 funds. All right. And then here we have just more detail on annual returns and that compared to the benchmark. So it slightly lags the benchmark. All right, this is the standard the fund is trying to meet, and it lags a little bit behind. But since you're paying lower fees, it really kind of balances out in the end. All right. Now, this also discloses some after-tax returns. Now, remember, when you sell at a gain, you have to pay taxes. All right. So your actual return after you pay taxes is not going to be as high. And I believe when they show these after-tax returns, they show it using the highest tax rates that you could potentially pay. So if you had this in a taxable brokerage account, this is what you would pay after you sold and paid taxes. So this is your return before taxes. This is your return after taxes on distributions. That's the interest and dividends, the SEC yield. And this is your return after you would sell the fund shares themselves. So you pay taxes not only on the dividends and interest every year that's paid out to you, usually at the end of the year, you're also going to pay capital gains taxes when you sell the fund at a gain. So this kind of demonstrates that you want to invest this money in a Roth IRA or a traditional IRA because you won't pay any taxes. Your returns will completely match before tax returns. Okay? Now, this is a comparison for the average target retirement fund. So even though the returns seemed higher up here, oh man, looks like it sucks. Well, if you look at the after-tax result, if this was in a taxable brokerage account, you would actually do better than the peers. So this fund is actually superior than the average target date retirement 2051 plus fund. Okay? All right, then we just have some recent returns. This doesn't matter. If you're a long-term investor, you don't need to worry about recent returns. All right, moving on. Let's go dig into the portfolio a little bit more. All right, so this is just a big snapshot of your asset allocation, or the percentages that you have invested in different asset classes. So here it just shows stocks, bonds, and short-term reserves, also known as cash, okay? This fund, since it's targeted to retire in 2060, this has 89% stocks and only 10% bonds. So it's pretty stock heavy. It's pretty risky in the short term. And over time, what will happen is as you get closer to 2060, this stock percentage will go down and down and down, and the bond percentage will go up and up and up. Bonds are less volatile than stocks. So you use the stocks over time to grow your wealth, and then you transition to bonds as you get older and closer to 2060 to preserve the wealth that you built over time with the stocks, okay? That makes sense, or hopefully that makes sense, okay? Here we have the net assets of the fund again. That's cool. More underlying fund information. Now, like I said, it's got U.S. stock, international stock, bonds, international bonds. And these percentages will change over time as you get closer to retirement, okay? Now, beta. This is basically showing how sensitive this mutual fund is compared to the Target Retirement 2060 Composite Index and the Dow Jones U.S. Total Stock Market Index, okay? Beta measures volatility. So if the stock market, let's say their Target Retirement Composite Index went up by 1%. Well, the beta is 1.01%, so it would actually go up slightly more, just a slight sliver more. It's slightly more volatile than the Target Retirement Composite Index. If the beta was under 1, it would be less volatile, as you can see here, okay? And the reason this is less volatile than the Total Stock Market Index is because there's some bonds in there, okay? Hopefully that makes sense. But if you don't understand that, you can look up more about beta somewhere else, okay? Then you have a little bit about the firm. This is Vanguard, blah, 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 blah. Who manages the fund, how long he's been there, all his amazing degrees, okay? This is more important when you're doing an actively managed mutual fund because you want to see if somebody's good at investing and how long they've been the portfolio manager. For a target retirement fund, which is invested in index funds and is basically on autopilot, it's not nearly as important, okay? But if you want to actually try actively managed funds, you want to know who the portfolio managers are, how long they've been on the fund, how long they've worked in wealth management, and I mean, if you care where they went to college, I don't really give a crap, okay? Anyway, moving on. Fees and minimums, all right? We already talked about this. This is the expense ratio. This is how much you're paying on your entire balance per year, and that's really low, trust me. All right, and this is the average. So if you had fees, you paid fees on $10,000 invested for 10 years, you would only pay $267, okay, over 10 years. That's nothing, okay? After all those massive returns, doubling your money in 8 years, that's nothing, okay? Fees are important. Now, if you had the average fee for this type of fund, you would have paid $540 more, okay? Fees are important. Fees affect your returns. They have a huge impact on your returns, okay? Now, here's a very important thing you need to watch out for. Fund-specific fees. All right, you got purchase fees, redemption fees, and 12b-1 fees. Now, the beauty of Vanguard is there's no purchase fee, so you don't have to pay any money up front right off the bat every time you invest. You don't have to pay any money to sell the shares, and you don't have to pay freaking recurring sales fees, which increase the fees that you're paying over time, okay? Now, if you see a purchase fee or a front-end load is what it's called, or a redemption fee or a back-end load or 12b-1 fees, you're getting ripped off. You don't want to pay these fees. This is one of the big things you want to watch out for because they can take up to 5-6% of every dollar that you put in. Okay, and this significantly reduces your returns. All right, account service fee, we charge $20 of a balance of less than 10,000. Okay, so you're gonna have to pay $20 if you have less than 10,000, but that'll change quickly. Blah, 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 blah. These are all different fees, and you want to read this. This is probably the most important thing that you want to read when you're researching a mutual fund besides what it actually invests in, okay? All right. These are minimums for different types of accounts, IRAs, UGMAs, UTMAs, and just a general taxable account, okay? Next, we go on to distributions. This is what the fund pays out, all right? Dividends. So last year, the record date, if you held the fund on December 26th, you were going to get this distribution of 80 cents per share, which is roughly that 2% SEC yield that you saw, roughly. All right. So if you got a distribution at the end of the year, they pay out the dividends or the profits of all the companies that were paid out to the fund, they're going to pay that out to you, all right, and capital gains and interest. And then you can reinvest it back into the fund. Now, last year, the reinvestment price was $38.26, okay? And then you have some capital gains and capital losses. So basically what's happening is when you give the mutual fund your money, they take your money, they take your cash, and they're going to buy more stocks that track the index, okay? Now, if you sell your shares, they have to sell those shares on the market and give the money back to you. So when they sell those shares, they're incurring capital gains. And those capital gains are spread equally over all the shareholders, and they're paid out to you at the end of the year to pay taxes on. Okay? Hopefully that makes sense. But basically, you need to pay capital gains taxes that are part of the underlying mechanisms of the fund. All right? Okay. News and reviews or whatever. All right. Now, one last quick thing. I know there usually should be something that shows what each one of these funds is invested in. So let's look up this total stock market index real quick, and I'm going to show you how diversified this investment actually is. And it is massively diversified, which is what you want. All right. Hopefully my computer doesn't crash. So let's just look at the US stock portion of this portfolio. Now we're looking at a different mutual fund. The Target Retirement Fund invests 54% of its money in this underlying fund, but this is not the entire Target Retirement Fund. Now, if you look at the portfolio and management, there should be a list of, there you go. Total stock market index. This portion of your portfolio, this 54%, is invested in 3,529 stocks. Okay? That's how freaking diversified that portion of your portfolio is. And you're going to see the same thing for the international stocks. So you're basically owning a piece of 5, 6, 7,000 stocks and thousands of different types of bonds. So if one company goes bankrupt, it doesn't matter. Okay? Hopefully that makes sense. And this kind of lays out like what the fund invests in. Healthcare, industrials, oil and gas, blah, 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 blah. Okay? It actually shows some of the stocks that are inside the total retirement fund. Apple, Microsoft, Amazon, Alphabet. And you can actually see them all here. You can see all the freaking stocks that this small portion of your portfolio invests in. So to conclude this video, if you have no idea what you're doing, you are completely new to investing, I recommend you invest in target retirement funds inside a tax-advantaged account. Roth IRA, traditional IRA, and your 401k if you have one. I want you to invest all your money in a target retirement fund that matches your retirement date. Now, once you learn more about investing, you're able to do more research on different types of mutual funds that you can invest in. And at that point, if you're not happy with the asset allocation or how the different parts of the portfolio are broken down, then you can sell that target retirement fund inside your tax-advantaged account, and you won't pay taxes on it. And then you can reinvest those funds into mutual funds that actually meet your investment objectives and risk tolerance. Okay? Now, if you like this video, smash the like button, subscribe to my channel, and I'll be making more of these later. You guys have a wonderful day.